as a reminder, this meeting is being recorded. There will be a copy of it available if you're not able to stay for the whole session, or if it's something that you want to go back and listen to later. We do plan to cover a lot of information and understand that some of the topics are very sensitive to an individual circumstance. So while we are talking about it high level and kind of broadly, if you have questions about your own tax circumstances, I encourage you to reach out to myself or another member of the team so that we can help answer questions that may pertain to your circumstances. In addition to the tax guidance that we can help give, I am reminding everyone that professional tax advice is something that always should be pursued and considered. So if you have a complex tax situation, or you have a question that is requiring that level of expertise, please make sure that you do ask a tax professional. And if you need a referral to one, we are happy to make that connection for you. As we talk about team updates, it seems like a good time to just revisit who on the team to reach out to. I get that question a lot from clients that says, who's the most appropriate person that I should be reached out to? So we have had some changes in our team recently, and I wanted to make sure that that continues to get communicated to clients. Andrew, who was working with us for the past couple of years, did end up moving further north and took a job that's up closer to Anacortes, where he was relocating. So Andrew is no longer a member of the team. In his absence, you can continue to reach out to myself, Nathan, or Julia with any questions that you have. Norma continues to be a member of the team. She is, however, working part-time. So if it's something that is time sensitive and you aren't sure about whether you'll be able to catch her during her working hours, I encourage you to reach out to the rest of us. And we are looking to expand our team. So as we have new team members join, we'll make sure to send out their contact information as well. You can also text us. That is a great way to try and communicate with the team because it goes to multiple team members. And so if you aren't sure who you should be reaching out to or who's available to get back to you, if you use that number, it goes to multiple team members, and then we can determine who's the best person to reach back out to you. I also want to make sure that I mentioned some upcoming events that we have. We have our quarterly economic update, which is going to be on April 11th at 2 p.m. We usually have our webinars on Monday. This one is on a Thursday because that was the availability that we have for our guest speaker, who is Gene Goldman. He's the Chief Investment Officer of Cetera Financial Group. So our broker-dealer who oversees us is he's going to be joining us and giving some really insightful and always entertaining information on kind of what's happening in the economy for the first quarter and then expected for the rest of the year. And then we also have a shred day coming on April 17th. So that is where you can bring any documents that you have to the office and have them, put into a locked industrial shredding container so that you can make sure that they're properly disposed of and not something that you have to worry about shredding on your own. We have a lot of people take advantage of that around tax time, but really anytime throughout the year you can bring documents in and we will help have them shred for you. So as we start to think about getting into taxes more, it's just interesting when you start to think about the history of taxes. And we're going to look at in a minute kind of how tax rates have changed over time. But income taxes first got proposed back in 1814, and that was at the time where it was the War of 1812, and they were looking for revenue to help support the expenses that were associated with the war. The war came to an end shortly after that, and so there wasn't a need for those extra funds. And it wasn't until 1862 that we had our first tax act that was put in place. And then what they found is that not a lot of people paid taxes, and so it didn't last very long. And it wasn't until we really got into the early 1900s that we started to see taxes actually kind of taking hold and Congress having the authority to tax American citizens. So when we look back at tax history, we think about just kind of that time period and how much we were paying during different times was really depending on what the circumstances were. You'll see here in 1915, 7% was the highest tax rate, and then it jumped substantially in 1945, and that was to help fund expenses associated with World War II. But even since then, tax rates were high back in the 80s. I'm sure many of you on this call can remember some of those higher tax rates. They came down in 2015, and then we had some changes that happened with a tax law that's actually set to expire at the end of 2025. You'll see here that we have 2024 tax rates. The highest rate there is listed at 37%, and then we have 2026. It's showing that it's reverting back to the 2015 tax rate. So we'll go over that a little bit more in a minute, but it's just interesting, I think, when we look at what happens with taxes over time and how that's going to be a big part of our planning when we think about going forward. Do we expect tax rates to be lower than they are currently, or is there a possibility that we're going to actually experience higher tax rates when we go into the future? Everyone's paying taxes, but this is also just an interesting stat as far as where does the most tax revenue come from. And you'll see that it's Americans who earn more than $200,000 per year are paying 65% of all of the taxes that are coming in as revenue. There's obviously a segment of the population that has very low income and are paying nominal taxes. And then we always think about those high earners and how much taxation is happening on their dollars and how that contributes to the total tax revenue that comes in. For 2023, the tax revenue that was collected was over $2 trillion. And so it's a really large part of the GDP of the United States. It actually makes up it's just under 9% or 8.8% of GDP. That's expected to continue to rise. So as I mentioned earlier, are we expecting taxes to decrease? No, we're kind of expecting taxes to revert back to previous tax laws, and then the possibility of further tax increases in the future. So it becomes an important part of our planning when we think out about taxes. We're going to talk about what we know now, so really focusing on 2024 taxes, but then we're going to get into some other things as we get further through this agenda, when we start to think about in the future, when we're distributing assets, if we're trying to gift assets, when we're fully in retirement. So really thinking about how do I have a full tax lens when I'm thinking about all of my different assets, instead of just getting too rooted in a single year, because that tends to be what we're experiencing in the now. Okay, so for 2024, we have some things that there's some changes just really due to inflation. And so the standard deduction has gone up just slightly from what it was last year. And I have a slide that'll show that in a minute. There still is no personal exemption. That was one of the things that has been repelled, and we are expecting to come back as those tax laws change at the end of 2025. There is a cap on the amount of state and local deductions of $10,000. It's the same as 2023, so we didn't see any change in that. The child tax credit is $2,000 per eligible dependent for those who have modified adjusted gross income over under $400,000 if you're married. Mortgage interest rate deductibility has stayed the same, so there's restrictions around that. And then alternative minimum tax exemptions did go up slightly, and I'll show those numbers again in a minute. So for standard deduction, these are the amounts that will be eligible for when you file your 2024 taxes. So that is next year. So we're thinking about income that's earned this year. So we did see a slight increase for married filing jointly. It went from $27,700 to $29,200. We'll go through each of those brackets, but each one goes up ever so slightly. And this is one where I think we hear most, people, the standard deduction has gotten so high that people are no longer itemizing deductions the way that they were previously. And so saying, are there other considerations I should be thinking about as far as ways to try and manage some of my tax liability. We did see a slight increase in the alternative minimum tax exemption. So this is saying that there's additional taxation that we have to pay if incomes are over these thresholds. And so that's where we saw earlier as far as, you know, who's contributing so much to the tax revenue. And it's a lot of the couples or individuals that earn more or have more income than these exemption amounts. Some other changes to note for 2024, before we get into tax law changes for 2026, there was the Secure Act had some additional changes that got implemented. 529 plans can now roll over to Roth IRAs. This is the first year that we're seeing this. Anytime there's tax law changes, there's always sort of a lot of kind of questions around needing some additional clarity, but there are some pretty specific language around what can be done. Essentially, individuals who are the beneficiary of a 529 plan, if they have not used the funds or will not be utilizing the funds for higher education, are able to convert to or roll over to Roth up to the annual contribution amount. So for 2024, that starts at $7,000, and you can do that for a handful of years up until you reach the maximum that the Secure Act allowed for of $35,000. So something that we're having conversations with more for clients who maybe had 529 accounts set up for their kids a long time ago and they did not utilize all of them. So if you fall into that category, that might be something that we want to discuss in your planning this year. Your Roth 401ks and 403bs no longer have RMDs. Prior to 2024, if you were an individual who had left assets with a 401k or 403b, an employer-sponsored plan, and you had not moved on to an individual Roth, they were requiring RMDs. That's no longer the case. Companies can match student loan payments with retirement contributions. The idea about this is to encourage people to continue to save for retirement, even if they have other obligations such as paying off student loans. And then there's a ability to take $1,000 emergency withdrawal from retirement accounts and not incur the 10% penalty. Additional changes that are expected for next year are the catch-up contributions. Right now, there's amounts that if you're over 50, you can do additional contributions to your retirement accounts. They're now adding an extra tier where once you reach age 60 to 63, that you can do additional contributions to help build up that retirement savings as you're getting closer. And then employers are now going to be required to automatically enroll employees in workplace retirement plans. And employees can opt out, but this is, again, something that's driven to say, how can we help people help themselves and really build up some retirement savings, knowing that the earlier you start and the more consistent you are with saving for retirement, it really makes a big difference in the long run. So maybe only applicable to individuals that are changing jobs, but might be something that you would pass along to other family members to just make sure that they're aware of that automatic enrollment is going to be starting in 2025. So when we think about this future timeline, you know, there's a lot of changes on the horizon, as I've mentioned. So this chart here just shows what of the current tax laws are set to sunset in 2025 and means that we'll have a reversion back to previous tax laws in 2026. So you'll see that most of the items listed here will be impacted. Individual tax rates and brackets, standard deduction, that personal exemption that I already referenced, the cap on state and local tax deduction, the child tax credit, which had been doubled, will revert back to what it was before, as well as the estate tax exemption. So this is a big one when we think about legacy planning. The current estate tax exemption is $13.6 million at a federal level, and that's going to get cut back to previous amounts. So there might be some planning for individuals to want to do around that. What is not impacted, I think that's most interesting on here, is corporate tax rates are going to continue. So one of the things that I get asked frequently about is these types of changes and impacts that it has from a market standpoint, and corporate tax rate cut, something that had a really positive impact on the market and is still going to be in play for another couple of years. So when we look at the tax brackets, this is what 2024 tax brackets are, and you'll see that there's columns for single, married filing jointly, married filing separately, head of household, and those ranges do adjust every year. We see that those ranges will go up slightly to adjust for inflation. What's going to change in 2026 is the tax rate, so the column that we see all the way on the left, and we're going to see that start to increase. The first one, it stays at 10%. The second one, 12% is going to go to 15, 22 is going to go to 25, 24 is going to go to 28, 32 becomes 33, 35 stays the same, and then the highest is set to revert back to 39.6. So the reason why I make a comment about this is that majority of the individuals on this call will be impacted because we have that 12 to 13, 22 to 25, and 24 to 28 is where a lot of clients fall, and those are brackets that are going to automatically be adjusted by 3 to 4%. So when we think about planning for taxes, that's just something that we want to be considering and knowing that we're going to have higher taxes down the road. When we talk about taxes, it's always important to remember that not all things are taxed equally. And so we do have just a reminder about how long-term capital gains work. So long-term capital gains are when you're selling an asset. It could be real estate, it could be a stock holding, anything that you've had for 12 months or longer gets long-term capital gains treatment. Now, if it's held for less than a year, then it gets taxed as ordinary income, which puts us back in those income brackets that we looked at a minute ago. But this is just a reminder for how much we're getting, how much can fall into the tax bracket of what gets taxed at capital gains, because some of our income that we have will fall into that category. And it can be that those are lower tax rates than we see from our overall tax bracket. So when we think about trying to minimize taxes, we're going to talk about what happens in retirement. But prior to retirement, there's some options to say, do we want to defer more to our retirement savings? And so when we talk about tax deferral, that means that we're putting money in that we've not paid taxes on, and we're going to pay taxes in the future. And so that is an effective strategy if we are going to be in a lower tax rate in the future. And we could be in a lower tax bracket in the future because we have less income sources, or we have greater control over when our monies are going to be distributed. So when we think about tax deferred accounts, that's going to be your 401k, individual IRA, annuities, health savings accounts. There are places where we can say, do we want to continue to put more money into those vehicles for tax deferral? It's just important that we keep in mind that those taxes on those will be owed in the future. And so it's not that we're necessarily totally evading taxes, it's that we're saying that they are going to be deferred to a future date. Now, there's differences in retirement savings. For a Roth, that's where you pay tax dollars, you put in dollars today that you've already paid taxes on, and then you have tax-free accumulation or growth on that. And when you take the distributions out in the future, you don't have to pay taxes on it. So it's really a matter of thinking about, do we want to pay taxes now, or do we want to pay taxes later? And that's something that's going to be a different answer for everyone, and it could be a combination of those. So we want to be thinking about, about that while we're continuing to save. Annuities, I mentioned, is tax deferral. So sometimes that can be advantageous to say, I don't want to pay my taxes today. I want to pay those down the road. Again, when I can control how the money is going to come out. And then there are other considerations for different types of investments that have different tax treatments. So just kind of giving some ideas of things that we can be considering. For those who are trying to maximize saving into retirement accounts, and so if we're saying traditional retirement savings where we're doing tax deferral, this would take that out of your taxable income. And so whether you're doing that or doing it to Roth, which doesn't take it out of your taxable income now, you pay taxes on it now, but either way, the limits are the same. And so for 2024, these are the limits as far as what you can contribute to retirement savings. For an employer-sponsored plan, it's $23,000 with a catch-up contribution of $7,500 if you're over the age of 50. And for IRAs, it's a $7,000 annual contribution with a $1,000 catch-up. I will say on the retirement accounts, obviously if it's an employer-sponsored plan, you need to be employed to be able to make contributions. But for individual retirement accounts, you have to have earned income. I have a lot of clients that ask if they can make contributions to Roth accounts now that they're under the threshold of the income limits to qualify. And unfortunately, you have to have earned income in order to be able to make those contributions. So I briefly mentioned that there's income requirements that make it eligible to make tax deductible contributions to your traditional IRA, or just to be able to make contributions to your Roth IRA. There are limits on how much income you can earn. And so if you're making contributions to individual retirement accounts and you want to revisit to make sure that you're under the threshold to make your traditional IRA contributions deductible, or just make sure that you're within the range to be eligible to make Roth IRA contributions, that's something we would definitely want to make sure that we revisit in our next conversation with you. So I mentioned Roth. People want to get money into Roth, and they are becoming more and more interested in them. And I think it's something that's just because it wasn't always available. So generationally, there was kind of a wave that missed out on understanding the benefits of Roth conversions or Roth IRAs. And so they're now saying, am I eligible to make a Roth contribution? And a lot of times they're not, because their income's too high or they no longer have earned income. So the option that remains available to anyone at any stage of life is Roth conversions. And this is where we take money from a traditional IRA and convert it to a Roth. So there's a couple of things. There's no income requirement to that, so anyone can do it. There are taxes that are associated with that. So it's really important that we understand, if we are converting Roth, that where are we going to have the money to pay the taxes? So if we did an example of, we did a conversion and the resulting tax was $10,000 in taxable and tax liability, we need $10,000 outside of the Roth to pay for that. We don't want the money to come from the money that we convert. So it's really important when we think about having the conversation of Roth conversion. So we know we want to get money into a Roth because it grows tax-free, but it doesn't always make sense, because depending on what your other assets are, what your income needs are, it may be that it's not going to be that tax beneficial. But when we do look at it, the reasons that it becomes really attractive is that there's no required withdrawals in the future. Since you've already paid taxes on it, the IRS does not force you to take distributions from it. So it can be a really great tool to continue to accumulate money for the future without any taxes associated with it, because you're not required to take that out. So longer time period where it can grow. It mentions there are additional estate strategy considerations. So if we're passing money from one generation to another, it's become increasingly more attractive to have Roth be the retirement money that's going to the next generation versus traditional. And the reason that is the case is because the laws changed, and when an individual inherits traditional retirement dollars, so money from a traditional IRA, they have a 10-year time period to distribute those assets. And so it gives them less flexibility to manage the tax side of that inheritance. where if you're inheriting a Roth, you still have to distribute the money in that 10-year period, but there's no taxes. So it's not as big of a challenge to navigate inheriting money that's taxable while you're potentially still working. So when we talk about, thinking about what assets we want to be legacy planning or planning to have the, next generation inherit, we really like to think about those Roth dollars as a possibility. It's important to note you cannot undo Roth conversions. So there used to be a provision where you could undo it before the end of the year. That is no more. So once we do it, we've got to be very committed to paying the taxes and having converted the money. There's no going back on it. And then there's some other considerations that I think everyone, every circumstance is going to be different, but we want to make sure that if you are considering a Roth conversion, that we talk about your circumstances specifically and make sure that it makes sense, not just for your own tax circumstance, but also for the rest of your planning. Where we're seeing it make the most sense is small pieces over time. So this graphic here is talking about filling up the bracket. And what it's saying is for many of us, when we looked at that 2024 tax brackets, we weren't necessarily going all the way up to the top threshold of our bracket. So in this example, it's showing that someone is in a 22% tax bracket, but they haven't maxed out the full 201,000 where that before it hits the 24% bracket for a couple that's married filing jointly. And so what that's saying is that, well, I'm already in a 22% tax bracket. How much room do I have to convert money, so take money from my traditional IRA and put it into my Roth IRA before I bump up into the 24% tax bracket? And so it might be that it's saying that we could do, in that instance, a $50,000 Roth conversion. And then, so that would get 50,000 out of that traditional IRA bucket into the Roth bucket. We would have to pay taxes at 22% on that. But that could make sense for this person's circumstances, especially considering that this same bracket is going to be going up to 25% when we have our current tax law sunset. So it's this idea of, maybe it's not that we're able to do $100,000 or $200,000 big Roth conversions all at once, but could we have a plan over a handful of years to achieve that by just making sure that we're not leaving any space in our current tax bracket? So filling up that bracket to take advantage of any room that's left in that. So again, if Roth conversions are something that you're curious about and would like to understand how that would work for your circumstances, definitely want to have that conversation and think about that. How much room do we have in your existing bracket? Or when we do our planning, is there some period on the horizon where you'll potentially be in a lower tax bracket for a small period of time? We see that when people retire but haven't started Social Security benefits or don't have a pension, things like that. So we want to make sure that we're taking advantage of those low income tax years when we can. Healthcare, I don't want to spend a ton of time talking about healthcare, but there's just additional taxes that come with that. So people that are high wage earners are finding that they're owing more in taxes around healthcare laws. So there's an additional Medicare tax. So in this example, it's showing that for a couple that's married filing jointly, if they make over $250,000, they're paying 2.35% in Medicare tax as opposed to 1.45%. And similarly, for a single individual, if their wages are over 200, they fall into that similar category. So getting hit with some additional taxes there. And then we've also had it come up where we have additional taxes that are owed from the net investment income tax. So again, this is for high wage earners. So for married filing jointly over 250,000 or single over 200, that there's additional taxes that would be owed on unearned income. So unearned income are things like taxable interest, ordinary dividends, capital gains. And so when we think about selling something that's highly appreciated, and we're thinking capital gains tax, for a lot of people, we also need to, in addition to that 15% capital gains tax or 20% capital gains tax, we need to add on this additional component as well. So just things that we want to be mindful of, that the taxes kind of continue to pile on once we're in certain thresholds. And in the state of Washington, there are some actually additional state-specific taxes that have come into play as well. So if your circumstances are such that you're in that $250,000 or more income, and you want to better understand the taxes that your additional taxes, I would say, that you're incurring, that's something to either look at your tax return, consult your accountant, or next time you meet with us, say, I'd love to have a better understanding of really what taxes I'm paying that are beyond the standard bracket. For people who are retired or nearing retirement and are going to be having Medicare premiums, like at age 65, eligible for Medicare, it's important that in addition to your income tax brackets, we think about your Medicare costs, because there's income-related monthly adjustment amount, IRMA, I don't know if that's something that you've heard before or not, that gets tacked on to your Medicare premiums. And this is different than your tax brackets, and it's also different ranges. So you'll see here that for married filing jointly, anything under $206,000, you're paying the base Medicare premium. And if you're a single filer, it's $103. But once you get above those thresholds, your Medicare premiums start going up monthly. The good news is that they look at your taxes annually. So if you do get bumped up into higher Medicare charges because of this IRMA, they revisit it every year. So it could be that there's a single year or a handful of years that you have to pay it, but not something that you have to pay forever. But it's something that people frequently get caught off guard with, because we're not paying Medicare premiums while we're working. So it's not something that we're thinking about. The other thing is we watch really closely those income tax brackets. And so that concept of filling up the bucket, I have a lot of people that monitor it and know right exactly where they're going to fall in those income tax brackets. But the income that we're taxed in those brackets is different than the income that falls into these categories for IRMA. So for IRMA, capital gains are included. So if you sell a real estate holding and had a one-time large capital gain, that will force you into these higher Medicare premiums. Again, could be just for 1 year in that circumstance, because your income would go back down. But the reason why I bring that up is that a lot of times when we have a large sale of that size, we get bumped up pretty high. And so we could go from paying $174 a month to all of a sudden we're paying $450 or $559, and that's per person. So if you're married, that means that you're both having to pay those higher Medicare premiums. So just something to think about as you continue to keep an eye on your taxes. And if you're thinking about selling something that would, kind of cause a high gain situation, it's a 1 year adjustment that you would experience. And the problem is that it happens kind of 2 years later, because there's a delay of when the information is getting reported to Medicare. So we sometimes have forgotten about that large tax bill that we had a couple of years prior, and then we're suddenly hit with higher Medicare premiums down the road. And I will say this is for Part B. There's also higher premiums for Part D if you fall into those higher categories as well. The other thing that, just while we're on healthcare, before we pop off of that, is to think about, are you in a circumstance where you have high medical expenses that you could deduct from your gross income? So we talked earlier about the standard deduction being high, and so a lot of people aren't in circumstances where they're doing itemized deductions. But if you have high medical expenses that exceed 7.5% of your adjusted gross income, then those expenses can be deductible. And it might be that this isn't something that's applicable to you today, and more so something to be mindful of in the future, either for yourselves or your families. So if we have people that are incurring high medical costs, then we just want to think of, is that something we could offset income with? And that can be a great planning opportunity. If we had, for instance, someone who was in long-term care facility and medically needed 24-hour care. Those are large expenses. And if we're able to deduct that against their income, it might be an opportunity where we could distribute some assets from a retirement account that haven't been taxed, or an annuity that has deferred taxes built up in it. So this becomes more of a, tends to be a later in life planning conversation, but something I wanted to include just in case someone in your family was experiencing high medical costs, and it could be an opportunity to talk about the taxes around that. Okay, we're getting closer to an hour. We're thinking about, we've accumulated assets. And when we accumulate assets, we accumulate them in different types of accounts. A lot of us are planning for retirement, so we have a lot that's building up in our retirement accounts, but we want to be really mindful of, from a planning standpoint, which accounts are we taking distributions from and when? So the first here is that we want to inventory all potential sources of retirement income. And that's where we want to think about all of your different sources that we have. Some of you, that's pensions. For most people, it's Social Security. We could have rental income. We could have assets that we've accumulated in a traditional IRA, a Roth IRA, an annuity. There's all of these different accounts or places that we've set up to help support us in retirement. So we want to think about all of those and come up with a plan on how we're going to distribute those and access those over time. A lot of time, people will default to wanting to distribute money from their traditional IRAs last. They want to wait as long as possible to distribute those. But if we've saved up a lot of money in that bucket, it can be something that really has a huge tax consequence when it comes, because those required distributions are just that, required. They are not optional. We don't have any choices as far as how to manage that. When the time comes that we're required to take those, it's going to leave us with very few tax options. So we just want to be thinking about, like I say here, the tax treatment for each of those, and balancing out to say, when does it make sense to distribute those? And sometimes it might be counterintuitive to what we previously thought. So whether that's, when am I going to start Social Security? When am I taking distributions from my retirement accounts? I have a lot of highly appreciated stock. At what point, do I want to start thinking about selling some of that versus continuing to have it accumulate and appreciate and get a bigger and bigger tax liability there? So those are the things, when we look at all of your accounts and holdings, we want to be thinking about the tax ramifications, not just today, but in the future. Considering adjusting your asset allocation, this plays into something we're going to talk about in a minute, as far as where do we want to own certain types of assets. And so I'll come back to that, and then we're going to talk about required distributions in a minute as well. Many of you have seen this kind of one-page summary for your financial assets. This is exactly what we're talking about, where we can pull everything together on one page. We've got our income sources in the top left. We have our retirement accounts in the bottom left. And on the right-hand side, we have our either tax-deferred annuities or individual investment accounts. In the bottom, we have real estate. And so looking at all of these different components of your financial life and coming to the game plan of, when are we going to trigger distributions from these various accounts in a way that can help minimize taxation or manage taxes as much as possible, which then helps to have us maximize the dollars that are going to you versus going to pay taxes. I did touch on required minimum distributions. The good news is that they've been getting pushed further and further out. So these are the distributions that you have to start taking from your 401k, traditional 401k and traditional IRA, because you have not paid taxes on them. So some of you could already be taking them because you fell into that category where prior to 2020, you had to take them at 70 and a half. Some of you might be in that category where it's 73 is when you'll have to start taking them. And then anyone who's born 1960 or later, under current tax law, you don't have to start taking them until 75. So what this does is it gives us a bigger window to be strategic about where we take monies from. I just want to say it doesn't necessarily default to we're not taking any money out of that account until 75, but it gives us a bigger window to have more control over which accounts we're pulling monies from and trying to manage some of that, the tax components around these tax deferred accounts. Smart asset allocation. This is one where it comes back to what kind of assets do we want to own in different account types. So if we think about when we're accumulating dollars, we want everything to grow. And so for early stages of life, we're a lot more growth oriented. And we can do that in a lot of different ways. So, mutual funds is a great way to do that. One of the downsides of mutual funds is that they can have tax distributions that we can't control. And so if we're still utilizing mutual funds, maybe we want to do that in an account where it's tax deferred. So those traditional IRAs where we are going to pay taxes on the money when it comes out, and we know what that's going to look like, as opposed to having some of those types of assets in accounts where we have to pay the taxes as they occur. Same thing with income producing assets. As we get closer to retirement, sometimes people want to balance and say, I want less growth and a little bit more balance. So I'm going to have income producing assets, and those could be dividend paying stocks or bonds that are paying us interest. Well, do we want to own those in an account where we have to pay ordinary income on the distributions when we receive them? Or do we want to hold it in an account where we, again, can delay those taxes to a future date? And again, there's different types of investments where we can say, what tax rate are we paying on those interest and dividends that occur? So a lot of this is kind of the work that we help you do to say, okay, these are all of the different accounts that I have. Where should I place the assets in each of these accounts to make sure that, again, I'm thinking about it from a tax standpoint, not just I want to have everything be doing the same. So there is some opportunity where we can be strategic about what type of assets are held in different accounts. All right, we're moving along here and getting closer to the meat of some of the different phases to think about in retirement. We're touching on some of them as we go, but gifting is something that tends to come up later in life because people have reached the point where they've done most of their accumulation and they're feeling confident that they're not going to need all of their assets for their own needs and wants. And so it becomes a consideration of either I want to give more to my family so that I can see them enjoy it. They may need it more now than they will down the road, or I'm trying to reduce the amount of assets I have in my estate before I pass away for tax purposes. And so we want to think about, what does it look like if we want to start gifting to individuals. And so in 2024, you're able to gift up to $18,000 per individual. And this goes up every year. So this is the new amount that we have for 2024. And the exemption means you don't have to report it against your lifetime gifting. And so you'll see there it says married couples can gift $36,000 to an individual. So if you have multiple children, you could gift, and you're married, you could gift $36,000 to each of them. And if they are married and you wanted to also gift to your son or daughter-in-law, you could double that even further. And so this becomes a strategy that we see more frequently used with clients that are saying, I want to give money to the next generation in a tax efficient manner. I don't want to do it in a cumbersome way. What's the simplest way I can go about gifting and not have, to file a gift tax return or have other issues. So I think that this is one that we are having conversations around more and more. It also can be a way where, again, if we had an objective that we wanted to meet and we knew that there was a handful of years to do it, we could do it over time utilizing this exemption. So I recently talked to a client that said that they wanted to help their child pay off their mortgage. And we looked at it and it was too big of a tax consequence to try and sell a big chunk all at once and gift that to the child, even if we were going to do something beyond the exemption amount. And so I just said, well, let's look at how much income you're earning in this account, and we'll start distributing that as gifting. So that then would let us, help them achieve paying off the mortgage, but we're doing it over a handful of years. That makes it more tax advantage to everyone involved. You do have a lifetime gifting exclusion amount, and that's currently ties into that estate. The lifetime exclusion is the same amount as that your estate can pass. So if you gift during your lifetime, it gets reported on your tax return, and then it decreases the amount that your estate can pass without taxation at the end. So that's the reason why we have to file this tax return, because it offsets or reduces your lifetime exemption. So you can use your lifetime exemption while you're living or when you pass away. And so it's not that it's a loss in one or the other, but if people want to do greater gifting during their lifetime, we just need to then make sure that we're reporting that on a gift tax return, because that is where it gets reported to the IRS and continues to get tracked. And so when you ultimately pass away and you're looking to settle your estate, they say, okay, great, of your current 13.6 million exemption, you've used 2 million of that. That now means that there's 11 million that you can, your estate can pass without further estate taxes. Keep in mind that this exemption amount is also set to reset at the end of 2025 and revert back to, it was 5 million before. It'll be adjusted for inflation, but this is one of those areas where we're going to see it decrease with the sunset of those tax laws. All right, so we've been building up and we've been thinking about, a lot of things that are happening to us in retirement. Now we want to tie it all together to just say, I'm entering the stage of life where taxes, I thought maybe weren't going to be as big of a deal as it turns out that they are. I think most people assume that they're going to have less taxable income in retirement. And unfortunately, we just find that that isn't always the case. So we're going to look at just kind of the time horizon here as we work through different stages of retirement. So before retirement, we want to think about knowing the value of our after-tax savings before retiring. And I think that that's really important, because we want to think about how much of that money we actually get to utilize. And so if it's been tax deferred and we haven't paid taxes on it, if we have $1 million account balance, we need to adjust for how much that is actually worth to us after taxes. And so when we think about that, we want to just make sure that we have a clear picture of how much money we're going to be able to count on in retirement. And so that's why we're thinking about this ahead of retiring. So it says down there, funding Roth accounts. I also like people to have just after-tax savings. So money in the bank, typically a larger amount than we would necessarily keep while we're working, because once we stop working, we have less opportunity to continue to accumulate savings. So we want to maybe have a little bit higher of a emergency savings or kind of that safety net of savings in the bank. Once we're getting close to retiring, we're starting to think about these different buckets of, when can I access income? What does that look like? So the next one we have is understanding Social Security and Medicare taxation. So we're going to talk about Social Security taxes in a minute. And I already mentioned that, taxation is in quotes there, because for Medicare, we have those extra premiums that we have to pay if we're in those higher tax brackets. So there is still an impact to some of the costs that we have associated around income and how that impacts what we have to pay for Medicare. Fill tax brackets in low income years, that's back to that fill the bracket visual that we looked at for Roth conversion. It doesn't necessarily mean that it has to be a Roth conversion. It could be that we just take more distributions from our retirement accounts early and then decrease the amount that we take from them later once we have other taxable sources. And so that's, again, looking at that one-page picture and working together to say, where does it make sense for us to be pulling dollars from? Managed planned RMDs, we talked about that a little bit. They are, just as they are stated, required. And so we know that they're going to happen, and let's have a game plan on how we're going to work with those. Utilize qualified charitable distributions. We're going to talk about that in a minute for those of you that are gifting to charities, and can use that as a tool to decrease the taxable income associated with required distributions. And then late retirement, we have organized your assets for tax efficiency and estate planning. So we talked a little bit about that, about really thinking about what assets do we want to distribute during our lifetime versus what assets we want to pass on to the next generation. And some of that is considering your tax circumstances versus your beneficiary tax circumstances. And there might be instances where you're actually in a lower tax bracket than they are. So if we're trying to manage taxes, we're not just looking at your taxes, we're also looking at that next generation or beneficiary taxes. Taxable and Social Security benefits. This is one that people frequently are frustrated, I guess would be the best term, at having to pay taxes on their Social Security benefits. So just wanted to include in here that income or Social Security income is taxable depending on the other income sources that you have. And so for most people, they kind of end up in that space where they're having to pay taxes on 85% of their Social Security benefits. So if depends on what filing status you have, but married filing jointly, you have to be under $44,000 in order to be in that 50% or less taxation on Social Security. So most people are going to have to pay taxes on Social Security. So it's important that we factor that in to the planning that we do. And then if you have questions on how it's calculated, I'd be happy to go over that with you for your circumstances. Qualified charitable distributions. This is, again, for people who are charitably inclined. So you're already making donations to charity and you want to do that in a tax efficient manner. What this does is it allows you to gift directly from your individual retirement account to a qualified charity and have that not count as taxable income to you. It can count as your required distribution, but you don't have to pay taxes on it. And so it becomes a really effective way in our planning to say, I know I want to continue to be supporting my charitable endeavors. I know I'm going to have these, required distributions in the future. And so if I can strategically say, that money is going to come from my retirement funds and not be part of my taxable income, then that can, like I said, allow you to continue to do that gifting, but do it in a way that really helps to decrease the money that is required to come out of your individual retirement account. There is an age restriction on this. You have to be 70 and a half in order to do this. So I have had clients ask before if they could, they're like, that sounds great. I want to start doing that. I'm gifting, annually to various charities. And so just want to make sure that we did note that it is age 70 and a half. That is the minimum age you have to be in order to do that. But if you have questions around this and how it fits into your planning, then I'd love to have that be something that we discuss next time we have a chance. I think I've been talking through all of this about kind of ways that we can help. And as this subject matter goes, it's a lot of moving parts, a lot of things to consider. And so I think the best way we can help is to sit down and look at your individual circumstances. So if there's, anything that comes up on your taxes that you have questions on, or if you're like, well, I just did my taxes, it might be a great time for us to look at this. And I would encourage you to reach out and schedule a time for us to connect. And just know that this is a lot of the work that we're doing behind the scenes for you. So we're really trying to come up with strategies that help us think about when you're going to be needing to access these monies, and then what's the most efficient way that we can go about doing that. And then helping you to understand that ahead of time, I think, is also really beneficial, because we all have these kind of preconceived thoughts of how things are going to go when we reach retirement. And so if what we're proposing is different than what you had anticipated, it's helpful to have a couple of years where we can really spend some time digging into that to better understand the logic behind that and really look at the numbers to understand tax efficiencies. Understanding the range of taxes that you will face at various stages, I think that's probably the biggest one. I already mentioned that a lot of individuals anticipate being in a lower tax bracket or having to pay less taxes in retirement. And while that may be true to some degree, it's rarely to the degree that people hoped that it would be. So I think that's something else that we can just sit down and look at it and say, here's the trajectory you're on, especially once we get to those required distributions. And so, as I mentioned before, we don't necessarily want to let those balloon up too big so that you get these large distributions at age 73 or 75, and now we're stuck taking those for the rest of your life. So in some instances, we might want to pay more taxes for a short period of time to pay less taxes once we get into those later stages of required distributions that will last, for as long as you're living. And then again, just really helping you to make good decisions when you are needing additional funds outside of planning, taking the thought process all the way through, understanding current taxes, tax implications that you might incur, but then also thinking through to say, this is also going to impact our Medicare premiums 2 years down the road, and let's make sure that we're thinking through the impact that might have. So it really is just that we don't want taxes to be driving all of our decision making, but it's definitely part of every decision we make, and really being mindful of what we, how we want to make sure we can help you minimize those, so it's not something that comes as a surprise later. So we did have, a question slide. I know we took up the full hour, so I'm sure that there are some questions for some of you that are maybe specific to your circumstances. So I think that we come back to encouraging you to reach out to us to schedule time to talk about your circumstances and or revisit your taxes if it's something that you're doing currently, and just saying, I've got some thoughts or kind of maybe questions around what's happening with my taxes right now. So looking forward to helping you get a better understanding of taxes for 2024, and happy to revisit taxes for 2023 if you're in the midst of working on that. And really appreciate you joining us today, and we look forward to connecting with you soon. Thanks again.